President Juncker took in his State of the Union speech that he delivered to the European Parliament a couple of weeks ago, and which I, of course, hope that you have read. And if you haven't, then I would suggest you go home and have a look at it. Which is to say that there is a momentum in Europe right now. We have what the President referred to as wind in our sail. That does not in any way mean that we should be complacent. There are clearly clouds lining up on the horizon, but it also means that this is the moment to do a little bit of a push for a certain number of in a certain number of areas. A lot of things have happened already, but I think in terms of banking union, the way we see it is that this is, and I think the President was relatively clear on that point also, that this is now the moment to complete the banking union. We have done a lot in recent years. We also see that the rules are working well. As you know, they were applied a couple of times this summer on a couple of banks. But it's also clear that there are some elements that are outstanding, also very well known to everyone in this room. They need to have a solid backstop to the Single Resolution Fund, and they need to finalize the common European deposit insurance. And from our perspective, this is the time to bring this debate forward. And debate, of course, been going on for a couple of years already. But our sense is that this is now the time to bring this to completion. And we think the moment is right. I think that it's always easier to do reforms during times of crisis. But it's also useful and good to, when you are in the little window of opportunity, when the sun is shining, to actually use this opportunity to mend your roof. And that is what we would think that's the right time for Europe to do right now.
Thank you.
Thank you very much. I think that returning from the summer, I had the hope that the world was going to be a little bit better. If you think about the crisis, we are growing in Europe, we are increasingly synchronized in the Eurozone in terms of growth, despite the problems of Brexit, and Brexit is a huge problem, let's not deny it. Things were getting better, but I think that after the summer, bit by bit, I started to realize that the world is not getting any better in terms of political risk. In fact, I think that what we call geopolitics, populism, well, you name it, is morphing, is changing its aspect, but continues to be a very relevant element in the environment that Europe is operating in. That means that although in Europe we have made a lot of progress in terms of institution building, crisis fighting, etc., I think that we cannot relax. And to be more specific in a couple of aspects. The world is still a globalized world, but we have this tendency of me first type of policies and approaches. And if the world goes into that direction, Europe needs to up the ante and be able to have a more cohesive internal strategy. Second example of a very, very clear nature, US, where US things are moving, it's in the direction of deregulation of the financial industry. There's a Treasury report that has been released highlighting basically the areas of reform, but these areas of reform do not only eliminate the gold plating that exists in the US, it also goes into the avenue of some of the international agreed standards. And also, even if they only touch the gold plating in the US, we in Europe have also our own type of gold plating. On resolution, we are far above what the international standards are, in terms of numbers of banks being included or indicative MREL target of 27% of risk-weighted assets. When you consider that TLAC is 18% for globally systemically important banks, that indicates that we are there being more ambitious than the rest of the world. I think that we need to consider in Europe, in terms of financial industry, what needs to be done. We cannot relax. We have done an incredible job. That the fact that we have banking union at all looks like a miracle, but I'm afraid that we cannot leave it half cooked. We need to complete the project, because if we stay in the middle, this is not good enough for the type of environment that we are going to be operating in the world as it stands right now.
So let's get specific about that. Let's talk about the European Deposit Insurance Scheme, which has been blocked for a very long time and is essential to completing the banking union. I mean, do you think we've reached a point where we know that Germany's been blocking it for a while, that there's always this tension between risk reduction and risk sharing? Is it something you think can come back to life, that the Commission can push back to life? And also then how do you incorporate maybe the German elections and some of the changes that might happen in terms of maybe the finance ministry there?
I think of course, the common deposit guarantee scheme, it's obviously a very important part, as I mentioned initially. I think it's also fair to say that contrasting to what's often said, that there is no progress whatsoever, I think the European Parliament with its rapporteur has done a lot of work in terms of trying to bring the dossier forward. Work is also ongoing on the Council side and has been so consistently since we presented this proposal back in 2015. Now, that is not to say that, in our view, that this progress has been fast enough. Of course, it has not. And it also seems clear that we need to think about what we can do to try to bring this forward in an as efficient and pragmatic way as possible. As you said, this is of course linked to the more general debate about risk reduction and risk sharing, which is also not new because we have been looking at this for the last couple of years. We had by the Dutch Council presidency in 2016 a rather detailed roadmap in terms of what needs to happen in parallel on the so-called risk reduction and the risk sharing side. I think we, from our side, think that a lot of these ideas are still valid and certainly need to be built on and taken forward. Now, on the issue of elections, there are always elections somewhere in Europe. We have elections coming up in Austria and the Czech Republic now in the next couple of weeks. Yes, there have been elections, of course, in Germany, and we will see how coalition talks will take place during the next couple of weeks. Now, I think the good news is that under all circumstances, Germany has a very Europe-friendly, will have a very Europe-friendly government. So to also be very precise to your question, one should not get the impression that the Commission would now, be contemplating on what made the new German position be. I think our sense is that we want to bring this file forward. It needs to be moved forward. It's very important, and we need to think of all collectively ways which are a good way of making this happen as quickly as possible.
But concretely, how do you do that?
Well, I think we can, for example, look at the report of the rapporteur in the European Parliament, which has taken up certain elements in terms of how can you face the various periods of the duration of or the entering into application of the common deposit insurance scheme. There are issues again. We've said from the very beginning, and the President was very clear on that also in his speech in September, which is that, of course, you should not get access to the common scheme until you have done your own homework in terms of dealing with risk reduction in your country, making sure that your own deposit guarantee scheme is being filled up. So I think there are lots of avenues that one may wish to consider and explore in order to bring this forward.
And Jose Manuel, how do you feel about the fact that this isn't finished? Do you think it's really impeding the finalization of banking union, or do you think
it's about the uniqueness of money? I mean, here I have a stronger position as chairman of the Spanish Banking Association than as vice president of the European Banking Federation. But I think it is not just one very important pillar of banking union. When one thinks about the US, the role that the FDIC has played, in really creating a single banking market in the US, it's a very relevant element. But it's also about the uniqueness of money. Without a single deposit insurance scheme, 20, 30 years down the road, the euro in a Spanish bank, the euro in a French bank, the euro in a German bank will be different things. That's the first thing that comes to my mind. Second thing is that we had to really make it very clear. This is not about legacy issues. Legacy issues pertain to the countries that have had problems. Deposit guarantee scheme in Spain, it has contingent liabilities coming from the crisis. This will have to be built by the Spanish banks, whether we love it or not. That's the reality. So nobody's expecting the European deposit guarantee scheme to compensate for things from the past. This is risk sharing, risk reduction, forward-looking. The past will have to be dealt by the countries that have had the problems. Nobody's expecting, any kind of generosity coming from this. We will have to foot the bill. It's not nice. Life is tough, as I always say. Let's move on. The third thing I would like to say is that I understand the problems. Let me be here very transparent, because I think that we are kind of hiding this for I don't know for how long. Since I was chairman of TEPS, this has been flying around. The problem with the European Deposit Guarantee Scheme is the situation in a country that is Germany, where you have a very atomized banking sector. You have a banking sector that has many actors. In that banking sector, probably the type of mutual guarantee system that they have, which is a very generous system, is needed to guarantee the stability of the system. So if I were German, I wouldn't like this to be, let's say, eliminated without knowing what would be the consequences in the stability of the system. Let's work it out. I mean, let's find a solution that fits, the needs of stability for the German banking sector, and at the same time allow us to move forward in terms of European construction. It should not be so difficult. Recognizing the different needs of a very, very specific banking sector in Europe that has thousands of banks, which is unique in the European context. Let's work it out, and let's think how we can be ensured that we can solve this problem without creating a more general problem of level playing field in the banking union. I think that it can be sorted out. You need imaginative solutions. Without imaginative solutions, we are not going to get there.
Mm-hmm.
Can I come back briefly on,
Yes.
just to pick up the point Jose made very rightly on legacy issues, because I think this is also a bit of the of a key issue here. I think that's also very clear from the beginning when we established the banking union and the new rules in general, that of course there would be if you wish, a period which would be some kind of transition from the old world taxpayer money bailouts and what we saw and had in the financial crisis, and towards the new system being in place. And of course that system also meaning banks building up buffers of bail-inable liabilities and all the rest of it. So I think it's also very normal and natural that we are now still in a phase where some of the issues we are looking at are in reality legacy issues. And as Jose said, this of course, and no one has ever said anything else, has to be dealt with in the banking systems of the countries concerned. Now, the good news is that if you look at non-performing loans, for example, we see that they are going down. They're going down quite substantially in Italy, also following the measures being taken this summer. But I think it's important to bear in mind that we have two different issues. One is the legacy, which has to be dealt with, and the other issue is what do we do going forward. And on the issue of non-performing loans, there, I think it's also clear that whatever we do in terms of new measures being proposed, and we have a very useful action plan agreed by the European Council from a couple of months ago, that will of course be for the future and make sure that our system is even more solid and proof for the future than it is today. That cannot per se deal with the legacy issues in the systems in certain member states that still need to be addressed.
But what we're talking about is legacy issues, and there's a lot to work through, and especially with just legislating in the EU, it's quite lengthy. Brexit's happened now, and that's a distraction and a complication, and that was something else we also touched on the phone. So do you want to comment on how Brexit could be throwing a wrench in banking union, or maybe distracting from having it be completed at a faster pace, and just putting it within that context? And then I guess as a follow-up on the Brexit question, does the UK leaving definitely give more impetus for deep EU integration? Were they holding it back all these years, and do you see that as maybe also compensating for the lack of momentum that there could be from them also complicating the process by exiting?
I think, first of all, I would slightly disagree with the fact that the European processes are very slow. I think in particular when it comes to financial sector legislation, it's rather remarkable how fast things have been, ranging from changing the deposit guarantee schemes directive within a period of 2 months in 2009, putting in place the new 3 European supervisory authorities in 2010, 2011, all the changes to the capital requirements rules, MiFID, and all the other rules that everyone here is very familiar with, leading all the way up to banking union, the Bank Recovery Resolution Directive, and which everything was, given the complexity and the novelty of some of these rules, actually were adopted by the 2 EU co-legislators in a remarkably fast period of time. So I think that I wouldn't entirely agree that our processes are always slow. Can they be more efficient? Certainly, but it's also part of the European democratic process, making sure that also all stakeholders, as yourself, can be involved in the process. So I don't think we should accept the criticism that we would be very slow in the financial sector area. Maybe other areas are different, but I think the banking area in particular, we have actually been very fast over recent years. Now, in terms of Brexit, is this a distraction? Well, I would rather say that what we have seen since the vote on the 23rd of June last year is a very large sense of unity between the 27 member states, with, of course, the meeting in Bratislava already back in September last year, leading up to the 60 years anniversary of the treaties in Rome in March, where the 27 renewed their, let's say, marriage vows to each other. And I think that is very much the spirit in which we're working now, going forward, and of course in that context, going forward with banking union, also going forward with capital markets union, extremely important also to complement the banking union. We have a bank-based financing of the European economy, and that's a good thing. We don't want to change that. But what is very clear is that we need to have deeper and more integrated capital markets, and that's why we also think that the work on the capital markets union is so important. We're trying to drive that forward with as much vigor as the banking union. So no, my answer is no. This is no distraction. I think we need to go forward on the EU's positive agenda, and that is exactly what we are trying to do from our side.
Mm-hmm.
Maybe let me change the order of the issues that you have raised. On Brexit, I would love to not to have this complexity on us. I get into denial mode very easily regarding Brexit, but it's there, probably is going to happen. For me, the best Brexit is one that would never happen. If we could kick this can down the road and make it a very, very long period of time, until retirement would be 12 years, so probably I'm a little bit too optimistic on the possibilities of kicking the can down the road. That would be perfect for me. But Brexit is here, and we have to deal with that, and we don't have so much time. Let's not fool ourselves. But then think about projects, European projects, Capital Markets Union. If we needed, with the UK Capital Markets Union, once you take the UK out of the EU, we need Capital Markets Union even more than before, because the dependence, the over-dependence of the European economy on the banking sector for financing is greater. And given the rules that we have been given, we will not be able to, over time, to reach all the corners that we have reached in the past. So it's good that we have a financial markets development that compensates from probably, the reduction in the size of balance sheets of the banks in the medium term, as all these, new world of regulation and also of digital transformation kicks in. So we need Capital Markets Union, and we need to do it fast, because we are talking about creating institutions that can take years to be created. So a sense of urgency there would be very, very important in the context of Brexit. The second issue is the flexibility of the EU in terms of speed of introducing legislative changes. Look, and now we are in Spain in the debate of the implementation of MiFID at the national level. I know we are very late, but the story, we have had several elections and everything, so there's a reason. When you think about the debate in Spain, I'm sure that Spain would have been one of the countries that would be fine with using the instrument of a European Union regulation rather than a directive. In the end, we have a directive on MiFID II. And the funny thing is that although Spain probably would have been one of the countries that would be okay with a single interpretation of the rules for all of the European Union, once you get into the internal debate, we start gold plating. All countries start gold plating, because you are giving Parliament a piece of legislation, you are giving the governments a piece of legislation, and they think, well, I can do it better. And you will end up having, the specificities being introduced in Spain that were not considered when the MiFID directive was being discussed. And in the end, we end up with something that is fractured, segmented, more complicated than it was before. So my plea here is fine with the speed, but why don't we use more European Union regulations? Because the use of directive in the financial sector is fear. Will introduce gold plating at the national level, and gold plating at the national level breaks the integrity of the single market, But when we are talking about banking union and capital markets union, it's just totally against the interest of creating this truly single banking market. So please use more regulations, use them more widely. Why not using regulations to harmonize retail products such as mortgages, for instance, and being a little bit radical there. So let's leave it like there before I get too emotional on the thing. But I think that we could use more regulations and less directives.
I have to respond to that. I very much I like regulations, just like you do. I think that if I would have had a government representative sitting next to me here, I think they would rather make a rather passionate plea for using more directives. So it all, of course, depends on your perspective. Now, that being said, I think if we look at what we've done in the financial sector over the last couple of years, we have increasingly used regulations. We've transformed the Capital Requirements Directive into a regulation and directive. We have also in the area of MiFID, the MiFIR, so the MiFID, so the Market in Financial Instruments Regulation. I'm not going to bore you with legal details, but there is an issue here that depending on the legal basis you use in the treaty, you are sometimes, by the authors of the treaty, obliged to use the instrument of a directive, and that's the case, for example, when it concerns the rules around setting up an establishment and providing services. And that is the legal base that we have to use for certain rules in the banking sector and in the market and in the capital market sector, which leads to a situation that although we, every time we can, try to use regulations and use the legal basis which has to do with the well-functioning internal market, we are sometimes for legal reasons still obliged to use directives. I would agree that regulations are good in the sense that, of course, very little national implementing measures being needed. It also provides clarity immediately for everyone that basically takes the regulation and reads it, including for market operators like yourself. So I think from our perspective, we certainly like regulation. The same is true for the European Parliament for the very same reason. And as I said, this is the spirit in which we're working, but again, unfortunately, there are some legal limits to what we can do sometimes.
I want to pivot a little bit because we are speaking about banking union and the Italian bank bailout this summer. Draw a lot of criticism from the press saying that the bailout for the Italian banks undermined the banking union and the credibility of rules. So I know that's an old piece of news, but since we're speaking in the context of banking union, could you give me your thoughts? Do you think that event undermined the banking union? What have we taken away from it that we could maybe use to improve banking union and its credibility if it was undermined at all?
Yes, and this one I'm going to respond relatively forcefully to because I think there's been a lot of not entirely correct reporting on this in the press. If we look at these four cases that we saw during the summer, the Banco Popular, the Monte Paschi di Siena, and two regional Italian banks, Banca Vicenza and the Banca Veneto. All these cases were different, because the banks were different and were in different situations, but each and every of these cases took place fully within the applicable rules and the applicable framework. We start with Banco Popular. This was a resolution under the Bank Recovery and Resolution Directive using the sale of asset tool that was carried out in perfect compliance with the rules. In the case of Monte Paschi, it was a case of precautionary recapitalization, also very explicitly foreseen in the Bank Recovery and Resolution Directive, meaning, of course, having been agreed by all member states and with the European Parliament. Precautionary recapitalization is there as an option in that directive, subject to very stringent criteria, which of course had to be observed in this particular case, and that was what happened here, and that's why this operation could be carried through. And then coming to the last cases, these were two regional banks that were small or relatively small in terms of importance in Europe as a whole, but of course systemically very important in these two regions in Italy. Again, BRB, the Bank Recovery and Resolution Directive applies. The Bank Recovery and Resolution Directive has as its starting point, as its actually its default rule, although it's often forgotten, that national insolvency law shall apply. And only if a bank is of the resolution of the bank is of a general European interest, does it go to the Single Resolution Board and is resolved or dealt with at European level. in this case, the decision of the Single Resolution Board was that this bank, it was not in the European general interest to resolve this bank, which meant that this bank went back to, in this case, Italian national insolvency law. National insolvency law was applied as if foreseen in the Italian system. Now, what many commentators picked up on was, of course, how could it be that this bank could get state aid? And there again, our state aid rules, our state aid banking guidelines applied. It was the assessment of the Italian authorities that in order to avoid disruptions in this region, some state support was needed for these banks. And we should not take this lightly. I mean, this is an issue, this would have been an issue of citizens or small businesses having a bank that would not open on Monday morning. Yeah? I mean, just think about your own region, wherever you're from. This is major, this is big, this is absolutely not good for the local economy. So this was the assessment of the Italian authorities, and then, of course, our state aid rules applied, including burden sharing, meaning that junior bondholders and shareholders were wiped out, also sometimes overlooked in the press reporting. And then these banks are, as you know, exiting the market. So I'm sorry to be a little bit lengthy on this, but I think it's very important here to not necessarily only read the headlines of the press, but actually taking the time to look into the details of the various cases. And then if you do that, I can reassure you that the rules have been applied into every last comma, the way they have been agreed by the legislators at the European level.
Let me here try to be very European, so I will take my European hat here as well. I think that we have to be realistic. If you are a small bank, it's very clear what is going to happen. You're going to go to the National Deposit Insurance Scheme and you are going to be, liquidated. Call it resolved, but meaning liquidation. If you are a big bank, it's very clear you're going to be resolved, and we have, the bail-in tools, non-preferred senior debt is starting to be issued, MREL is starting to be filled in, and it's very clear that for the big banks, you will have recovery and resolution planning, very careful done, and a good structure of liabilities that will ensure a smooth bail-in going forward. But we also have to recognize that the cases that we have had in the last months create a doubt of what is going to be the rule, those 120 banks that are under the Single Resolution Board remit. I would say the 60 biggest, they are under this big bank type of group. The second 60, the market may have doubt what is going to happen. If you are in a certain country and you are non-preferred senior debt holder, you are going to be bailed in. If you are in another country, you are going to be, leave aside because government money is going to go in. Do not disregard the importance of clarity towards the market of what are the conditions of resolution of this second tier of banks. More generally speaking, I think that with this second tier of banks, I think that MREL can be very tough to comply with, and for big banks, we have seen examples. The government in Spain changed the law June, July. We can issue now non-preferred senior debt. We are seeing these issuance going very well for the big names in my country, but for the mid-sized banks, it's not yet clear that there's a market there at a reasonable price. So I think that on the small banks, there's a clear avenue. On the big banks, there's a clear avenue. On the intermediate banks, it's not clear what the conditions are. It's not clear whether they will be able to have access to markets so that they can comply with MREL. So I think that we have a question mark here, and uncertainties that we should fill in the coming years.
I can maybe come back briefly on that. I think that brings me back a little bit to what I said in one of my previous interventions, which is the fact that we are, in a way, I used the word transition phase, and it's not ideal because it's not exactly that, but we are in a phase between, if you wish, the old world and the new world. And I totally appreciate and agree that, of course, this was the first time these rules were really applied. I can also understand why there was maybe a little bit of confusion. How does the rule work? Who does what? How does it work in practice? Now, I still think that the rules are now there. Are they perfect? Probably not, because very few things in life are perfect. But I would think that rather than starting thinking about what needs to be changed here and there and start opening up legislation, etc., let's rather try to work with the legislation we have and make sure that we implement it and apply it in as good a way as possible. of course, there are issues to be looked at. I totally agree with that. But I think I think the starting point at this point has to be that we want to make the rule, the framework that we all agreed during the financial crisis work as well as possible.
And it is true that if you look, and let me agree with you, if you look at what has happened in all these banks, the good thing is that there has been no contagion whatsoever. So it's good. It has worked. Maybe we have these, second-tier issues, but it has worked. It has worked very well with no contagion whatsoever, and that is really very important. So I think that the fact that I'm posing this problem does not mean that we are failing in terms of resolution. On the contrary, we are applying this for the first time. Resolution is going always to be messy and tough. Let's not fool ourselves. But the fact that we have had these cases and with no contagion whatsoever, I think that that's a very good element. And we should put it in the credit of the European Union. So not to be too sound too negative on my side.
But we're talking about transition, and transition can sometimes mean lack of clarity. Lack of clarity is not necessarily the best thing for businesses. That's something a lot of banks have said over the years. We need clarity on what the rules are so we can move forward with our business models and focus on what we need so that we become more profitable and contribute back. So what I would like to know is sort of from the banking side, what would you say is unclear to you that you would like to see resolved from a Commission side so that you guys can maybe have that discussion? And then I'd like to open it up for some questions to the audience with the remaining time we have left.
I think that I would mention, I think that the problem that we have is not so much legislative action, but the fact that many of the reforms that have been introduced are very novel. Resolution, for instance, and it will take time to roll out the system and to know how it works in practice. So I don't think that it's the legislator anymore. It's more the authorities involved, the ones that need to give clarity on the way forward. The second element, I think that it's relevant. We have been talking the whole morning, Wim, about digital revolution and digital transformation. This is going so fast that even though the European process, you have to find a balance between, democratic legitimacy, and we have had problems in this area, in the last years, and we have to recognize that we need to do it not less but better. But at the same time, the digital transformation is going to go so fast that I think that we need to prepare ourselves to a new world that is going to be measured not in years but in months. Every time you go to a conference, biotechnology, cybersecurity, you name the field, it's astonishing the speed of the positive things and on the potential negative things. The other day I was with a former American regulator, and basically what she was posing the question, well, I hope that the authorities have a plan when our digital credit cards, digital mobile banking applications do not work, because there will be one day in one city, in one country in the world where this is going to happen. We need to prepare to a new world that is going to be far better in terms of all the aspects of life, but also, with some dark aspects. And I'm not sure that, our very heavy process, with lots of guarantees, is prepared to that type of evolution.
Maybe a few reflections from my side also. I think that the first on the need for clarity, I think that is of course true. It's also true that we legislated enormously during the financial crisis years for reasons that I think everyone will understand. It was also very much in light of what was at the time the global agenda. I'm sure you have noticed that since the Juncker Commission took office, the amount of new proposals being presented in the area of financial services have gone down very significantly compared to what we did a couple of years ago. And that is logical because the main pillars are there. We need to do things on capital markets union. That's what we do also. We needed to do certain adjustments to work on the risk reduction. That's why there is a banking package on the table since November last year. But I think by and large, I think we are very much in the spirit now of let's implement and work with the rules that we have. Are they perfect? No, they are not. But let's work with them now rather than starting to rewrite the rule book every 6 months or so. And I would have thought that is probably something that most of you can agree with. Now, on the issue of the digital transformation, I agree this is a huge challenge. I mean, in the financial sector, but it goes, of course, far beyond that. I think we live in a world which is changing a lot, with everything that means also for changes in value chains. The fact that the jobs that disappear are not the same jobs that are being created somewhere else in the value chain, and this is something that we certainly need to relate to all of us. Now, I think when it comes to how regulation can actually deal with that phenomenon, I think that is a good question to ask oneself, and I think it's right to come to the conclusion that traditional processes may often be too slow. On the other hand, for me, the fundamental question is, and we run a public consultation on this a while ago, as I think you are aware, and we are working on an initiative in the area of fintech for the beginning of next year. But for me, the real issue is that what exactly needs to change in the regulatory framework to actually harness and take these new developments into account. Because what you very often hear when you speak at conferences or roundtables or what have you is that everyone agrees that fintech is coming, is changing radically and transforming radically the financial sector in general and the banking world as we knew it. I think there, so far, no disagreement. But I then usually ask the question, so what exactly do we need to change in our current regulation to make sure that we are dealing with the new world in an appropriate way? And then it often becomes a little bit more silent in the room, because it's easy to have the general sense that something needs to change. But if we then look at our various pieces of legislation, it's not always that obvious to pin down what needs to change. And then, as was rightly mentioned, if we change things, we have a long process to make it actually be implemented. And during that long process, probably the world will again have changed around us. And then we would find ourselves with legislation that's not necessarily up to date. So I think, generally speaking, in the area of fintech, I think it's also a matter of seeing what can we actually do within the framework of our current rules. And you know better than me the discussions around regulatory sandboxes and other initiatives where one can kind of try to help innovation thrive, but of course at the same time making sure that we take financial stability concerns into account, and also obviously the safety of the money that consumers or investors are putting in somewhere.
I think that's true, and that's very interesting. I'm improvising, so don't take my words very seriously. But I think that precisely because if you ask me what changes do you need for the digital transformation, my answer would be I have no idea, and it's true. So in terms of the future, I think that the only way you can deal with this is through greater flexibility in terms of the supervisor having a greater room for maneuver to deal with the issues. Have a legislation that is not so detailed in this aspect, that gives regulators and supervisors greater room for maneuver to deal with emerging issues and emerging needs. Maybe that's the only way that things can go.